Hook, 0.30s. Here's a number that should stop you cold, $3,000. Pause. That's the average amount the typical American investor leaves on the table every single year, not because of bad stock picks, not because of market crashes, but because of one specific annual decision they keep getting wrong. Emphasis. One decision, every year, and over 30 years compounded, that mistake costs you somewhere between $280,000 and $400,000 in historical average growth. Pause. Stay with me, because by the end of this video, you'll know exactly what that decision is, why 74% of people get it wrong, and the dead simple fix that takes about 15 minutes once a year. Problem: 30s to-do men. Let's talk about what most people think investing is. Most people think the game is about picking the right assets, find the hot sector, rotate into the right ETF, time the market just right, and look, that's not crazy. That's what financial media sells 24 hours a day. Pause. But here's what the data actually shows. A landmark study by researchers at Vanguard found that asset allocation, meaning how you spread your money across categories, explains roughly 88% of a portfolio's long-term performance variability, not stock selection, not market timing. Emphasis: asset allocation, the boring part, the part you set up once and then mostly forget about. And that forgetting? That's the $3,000 problem. See, when you first build a portfolio, you probably set something intentional, maybe 70% stocks, 30% bonds, maybe 80-20, something that matched your age, your risk tolerance, your goals. You felt good about it. Pause. But markets don't stay still. Stocks have a great year. Suddenly you're at 85% stocks without touching anything. Or bonds rally. Now you're more conservative than you wanted to be. Your portfolio drifts, silently, every single month. And most investors have no idea it's happening. This is called portfolio drift. And according to a 2022 Morningstar analysis, the average retail investor's portfolio drifts more than 12 percentage points from their target allocation within just 18 months of setting it. Emphasis: 12 points. That's not a rounding error. That's a completely different risk profile than what you signed up for. Solution: 2.7 mine. The fix is called rebalancing. And before you click off thinking you already know this, hear me out. Because most people who say they rebalance are actually doing it wrong. There are 3 specific insights that separate the people who rebalance effectively from the people who think they do. Pause. Insight number 1, the calendar trap. Most financial advice tells you to rebalance once a year on a fixed date. January 1st, your birthday, tax season. Pick a date, stick to it. And look, this is better than nothing. But here's the problem. Markets don't care about your calendar. If the market drops 30% in March and doesn't recover until October, a December rebalance means you spent most of the year with the wrong allocation during a volatile stretch. Pause. A smarter approach, used by institutional investors and some robo-advisors, is called threshold rebalancing. Instead of a fixed date, you rebalance whenever any asset class drifts more than 5% from its target. Some investors use a hybrid, check quarterly but only rebalance if drift exceeds 5%. Research from Rowe Price suggests threshold rebalancing can improve risk-adjusted returns by 0.4% to 0.8% annually versus calendar-only rebalancing. Over decades, that difference compounds into real money. Pause. Insight number 2, where you rebalance matters as much as when. Here's the one that trips up even experienced investors. Every time you sell an asset in a taxable brokerage account to rebalance, you may trigger a capital gains tax event. Emphasis. That means your disciplined rebalancing could be silently eating your returns through taxes every single year. There's a smarter sequence. First, rebalance inside your tax-advantaged accounts first. Your 401k, your IRA, your Roth. Zero tax drag when you shift allocations in those accounts. Second, In taxable accounts, use new contributions to buy the underweight asset instead of selling the overweight one. You're rebalancing through addition, not subtraction. Third, if you do need to sell in a taxable account, prioritize assets you've held more than 1 year to qualify for long-term capital gains rates, which are historically lower than short-term rates. This 3-step sequence can save the average investor $800 to $200 per year in unnecessary tax drag, and that's a conservative estimate. Pause. Insight number 3, the emotional override problem. This is the one nobody wants to talk about. Rebalancing, by design, forces you to do something that feels deeply uncomfortable. Emphasis. It makes you sell your winners and buy your losers. When tech stocks are up 40% and bonds are flat, rebalancing means trimming tech and adding bonds. Your brain screams that this is wrong. Every financial headline confirms your winners are winners, and so you override the system. You tell yourself you'll rebalance next month, and next month becomes next year. A 2019 DALBAR study found that the average equity fund investor underperformed the S&P 500 by 4.35% annually over a 30-year period. Not because of fees, not because of bad funds, primarily because of behavioral decisions around buying high and selling low. Pause. Rebalancing is the mechanical antidote to that behavior. It forces buy low, sell high by default. The investors who outperform over long horizons aren't smarter. They've just removed the emotional decision from the equation. So how do you actually remove the emotion? 2 options. 1. Automate it. Most major brokerages, Fidelity, Vanguard, Schwab, offer automatic rebalancing inside retirement accounts. Turn it on. Set your threshold. Done. Option 2. Use what behavioral economists call a commitment device. Write your target allocation down. Tell a spouse, a friend, or an accountability partner. Pre-commit to the rule before the market makes you feel like breaking it. Research from the University of Chicago shows pre-commitment to financial rules reduces behavioral deviations by up to 37%. Pause. And here's where the $3,000 number comes from. When you combine tax drag from poor rebalancing location, behavioral return gaps from drift, and the cost of excess volatility from an unmanaged allocation, Vanguard's own Advisor's Alpha framework estimates that disciplined rebalancing adds approximately 0.35% annually in net value. On a $200,000 portfolio, which is roughly the median retirement account balance for Americans in their 40s, that's $700 per year. But remember, this compounds. At historical average market growth rates, that 0.35% annual improvement, compounded over 30 years, represents somewhere in the range of $280,000 to $400,000 in additional portfolio value. Divided by 30 years, that's roughly $9,000 to $13,000 per year in future value terms, and the present value equivalent of that gap runs right around that $3,000 annual figure. Emphasis: $3,000 every year from a 15-minute annual decision. Proof: 7 to 9 Mia Men. Let me make this concrete with 2 real historical scenarios. Scenario A. An investor starts with $100,000 in 1994, 70% S&P 500, 30% bonds. They never rebalance. By 2000, after the dot-com run-up, they're sitting at roughly 88% stocks. The 2000-2002 crash hits. Their unmanaged portfolio drops approximately 38%. Scenario B. Same investor, same starting point, same allocation. But they rebalance every time stocks drift past 75%. They enter 2000 at 73% stocks, close to target. The same crash hits. Their portfolio drops approximately 24%. Pause. That's a 14 percentage point difference in drawdown from the same market event. And because they lost less, their compounding base going into the 2003-2007 recovery was significantly higher. By 2007, Scenario B investor has roughly 22% more in their portfolio than Scenario A, without making a single different investment decision, just rebalancing. This pattern repeats. It played out again in 2008. It played out in 2020. Emphasis: the market doesn't reward the people who pick the best stocks. It rewards the people who manage risk consistently over time. CTA, 9 to 10 yen. So here's your 15-minute action plan before you close this video. Step 1. Log into your largest investment account right now and check your current allocation versus your target. If you don't have a target written down, that's your first problem to solve. Step 2. Identify which accounts are tax-advantaged. Rebalance there first. Step 3. Turn on automatic rebalancing if your platform offers it. If not, set a recurring calendar reminder to check every 90 days. Pause. That's it. 3 steps, 15 minutes, potentially $280,000 in long-term difference. If this video gave you one thing you didn't know before, hit subscribe, because next week we're covering the second most expensive money mistake average investors make, and it's hiding in something almost everyone has in their portfolio right now. Emphasis. You don't want to miss it. See you there.